keeping your analysis concise and simple, creating a repeatable process for your technical analysis, defining overbought and oversold conditions, and Katie analyzes the S&P 500 and Bitcoin. All this today and more on the Futures Radio Show podcast with founder and managing partner of Fair Lead Strategies, Katie Stockton. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. For new show notifications, please subscribe to Futures Radio Show podcast on iTunes, YouTube, Google Podcasts, Spotify, or Stitcher. This show is also sponsored by Trading Technologies, RJO Futures, and FTSE Russell. The Russell 2000 is a key benchmark for small cap U.S. stocks. Be sure to check out the E-mini Russell 2000 futures symbol RTY and Micro E-mini Russell 2000 futures symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. So, Katie, as we're sitting here just getting started to record this show, I've been looking at a chart of Bitcoin, and obviously because the price action has just been nuts lately, we're sitting back at all-time highs, and Bitcoin is one of those markets that I traded, a little while back, and the primary reason I was trading it is because it was working really well with the technicals. And there's just not really a true fundamental story here. I know someone maybe disagree with it, but there's really not, it's not an actual physical commodity. Obviously, it's a hedge against central banks. I get that. But aside from that, I don't know how much fundamental analysis someone could do on it. But anyway, as I'm sitting here getting ready to chat with you, I was looking at Bitcoin. All I could think about is, I'm going to see what Katie thinks about it. Maybe we'll touch base on that a little bit later. But it's because it's really the only way I look at trading Bitcoin, aside from the other markets that I trade, is technical analysis. And although at one point I do want to hear your thoughts on Bitcoin, I just want to start off with today by just wondering, how did you get into the role of being a technical analyst?
Right, and I agree with you on Bitcoin. I do think technical analysis is really the best, and perhaps right now one of the only ways to approach it and try to trade it successfully. So I agree with you there. Technical analysis is something I really stumbled into, and I think it was very lucky and fortunate that I went to a school that actually had coursework in technical analysis. So I was already on a finance track in college, but was able to take a course in technical research. So that, of course, exposed me to it at an early age. And I then picked up an internship with a firm called Dorsey, Wright and Associates. They do point and figure charting. So if you can visualize a bunch of X's and O's on a chart, that's the point and figure charts. And I had the pleasure of working there for a couple of years. And that really immersed me at a very young age in technical analysis and exposed me to its value, while at the same time I was essentially on a CFA track in college. So I brought to my professor all sorts of charts and said, you gotta pay attention to this stuff because it works. And I was scoffed at a little bit, but now, of course, we're still in touch, and he's come around to the fact that this is a discipline that's not going anywhere, and I really see it as the ultimate sort of complementary discipline to fundamental research. It's something that can facilitate market timing, risk management, opportunistic positioning, things like that. And I don't see why anybody wouldn't use it, whether in trading or investing.
Spoken like a true technical analyst, right? Why would anybody not want to look at a chart? I feel the same way. I over the years, I've grown more into looking at the macro side of things, and it definitely has a place in my trading. But I think for traders, if you look at charts, they either resonate with you right out of the gates, like how it did with you, or really they don't, and you go a different path. Because to me, it's like a love it or kind of hate it thing, because once you get into learning about charts and analysis, it takes a lot of time.
It does. It's not the surface level discipline. You do really have to dig into some of the tools that are available, but there is a way to keep it simple. So that's the good news, and certainly there's a lot of information out there that is very accessible. So I would say that a lot of times for folks, it takes just one really good successful trade with a chart that kind of gets you coming back for more. So I always tell the traders that I talk to that have the challenge of working for a portfolio manager who's more fundamentally oriented, and they say, oh, he just won't pay attention to it, or she won't pay attention to it. And I say, well, just keep feeding those ideas, because eventually one's just going to trigger, and that's going to help them understand the value in it, whether it means just, you want to reduce exposure to this name, that type of thing. When it really works, I think that's the added value that people are going to come back for.
Yeah. And really how I found you was, a few of my friends that are more on the macro side want technical analysis. Even some traders I know that use technical analysis like to look at your research as well, because I know that you have papers that you put out, and you put out analysis on a lot of the futures markets that a lot of our listeners trade and listen to. And you mentioned that there's a way to keep it simple. And you said that you started off with point and figure. I actually kind of started off with point and figure too. I think it was one of the first charts I saw, because in the pit, when I started, guys, it was actually easy for them to actually they had the chart in front of them and they would just plot point and figure. But anyway, I moved on from point and figure like you did as well. Talk to everybody about what it is. What is your technical process now?
Yeah, and I do try to keep it simple myself. It's my day job. So with that, it means I probably get a little bit deeper than the average investor or trader. But when I publish research, I try to keep it really concise and simple and, as I said, accessible to everyone, in that I'm using a discipline that starts top down. So I tend to be US equity centric in my work, but I look at all sorts of macro technicals, as I mentioned. So I start with the major indices, and I really believe that it makes sense to be top-down oriented, because if you think about investing in individual stocks, if you're wrong on the direction of the S&P 500 as one, you're probably wrong on the direction of the individual stocks to some degree. So it really is important to have that directional bias spot on for the broader market if you want to succeed on the sector front or for individual stocks. We really start there, but then of course we do what we call a lot of bottom-up work to support that. And our version of bottom-up work is looking at a lot of individual stock charts to support what we're looking at for the major indices, primarily the S&P 500. And that hard work, and it is hard, it is tedious, really does facilitate our broader view, because the S&P 500 doesn't always tell the whole story of the market. You can see things like breadth or market participation when you scroll through the 500 charts that comprise the S&P 500 in a much more robust way. So our process is to start with the major indices, look at the constituents, look at the sectors, and apply the indicators that we find the most value in. And I think that's really the key to succeeding in technical analysis, is coming back to the same tools, whatever those tools may be. So just to have a methodology and to come back to those same indicators, or even no indicators at all, just a price chart with, say, a moving average, something like that. As long as you have a process, you have a methodology, I think that's really the key, because you start to learn patterns and trends and sort of high probability or low probability scenarios like breakouts and breakdowns over specific levels. So when we look at a chart, we're starting with support and resistance, and support's a potential area of buying pressure, resistance is a potential area of selling pressure. The hard part is that you can really identify those levels in many, many ways. And that's where the experience comes in handy. Now, the easiest way to get experience is by just looking at charts all the time. So it's something anyone can do. But like I said, to come back to the same charts over and over, then you'll start to really understand those dynamics of support and resistance. So that's where we start. And then we're consulting a series of indicators. And there's so many books out there and so many tools. We have a CMT, or Chartered Market Technician designation. And that program or course of study really sort of facilitated us or helped us establish our discipline and to find the indicators that we find most suitable to our sort of process and the way we think about the world. So we have a series of indicators that tell us, 1, trend following or momentum, 2, overbought, oversold, and 3, relative strength. So the relative strength for us tends to be applied for the most part on the sector front, so looking at US sectors versus the major indices. But of course, we can look at other things like growth versus value, small cap versus large cap, international versus US, things like that as well. For trend following and momentum, I always tell folks just to have 1 or 2 indicators for each category. And that's one other way to keep it simple. And it almost doesn't really matter which indicators you're using, as long as I mentioned, you come back to the same ones, because no indicator is perfect, but their design typically is to reduce noise and to help you stay on the right side of the prevailing trends over whatever time horizon you're focused on. So on a short-term time horizon, you'd be using likely a daily bar chart or an intraday bar chart. And with that, you'd have a certain moving average or moving average based gauge to understand the prevailing trend. It might not be someone who, focuses long-term would care about, but they have then, say, the monthly bar chart that they can go to and apply similar tools. And then the overbought, oversold readings, same thing there. Have 1 or 2 gauges that you just keep coming back to, and then you'll get to know their nuances. And I think that's where the value is, and coming back to the same tools over and over. Beyond that, we tend to also look at the market internal measures. For that, it's really US centric as well. And it's things like sentiment and breadth and leadership and volume. And all of those things inform our analysis. They're a little bit fluffier, is how I describe them, meaning we tend to not always pay attention unless they're at extremes. They tell a story about the market, which the clients really demand that. And yet, at the end of the day, technical analysis is really just the study of price. So there's not often a story as we can derive from fundamental or macro research. It just is what it is. We're saying, here's the prevailing trend. Here's where it likely matures based on resistance. Here are the statuses, the indicators that we use. And here's how we're positioning with all of that in mind.
We have a lot in common. We think very, very similar. First, by repeating that process over and over again, that is absolutely, to me, one of the most important things. And you said something that I 100% agree with, is that the choice of the indicator is not really what matters the most. It's about repeating that process over and over again. It's what resonates with you. You and I both like support and resistance. That's what I use. That's what resonates with me. I mean, you could show me something else that maybe has a statistical better edge than that, or whatever it is, and it may not resonate with me, so I may not execute it as well. So and I've looked at support and resistance for so many years, and I have my own way of approaching it and trading it, that's what works for me. And I think that that's so important. And that's great hearing that from someone who's a CMT who really, you're saying that the technicals matter, but what we're doing is the way we're looking at it is we're repeating this process over and over again because we're getting really good at this one specific look.
That's right. And you'll start to see, history rhymes, right? Or repeats itself to some degree. And I think we're looking for trends. We're looking for things that we've seen before or seen something like before. And that can add value. And that's why just looking at charts is really an important part of this process, and something that's very difficult to recreate using AI or computers. I think it's something we can facilitate using software, but it's not something we can fully replace, that kind of visual element. I found that in trying to develop filters and scans that they're quite good and helpful, but they don't tell you the complete picture. You almost always miss something, I found, by using software to try to identify certain setups. So I really think there's value in just doing it yourself. And with that, I think you can be more systematic in your approach. And I think that the drawback of going out there, maybe logging into Twitter and saying, oh gosh, this is what that technician is saying now. This is what that technician is saying now. And what I think happens is that you grab onto whatever, technician is saying, something that is aligned with your views. Maybe that confirmation bias, I'm not sure. So I think there's almost risk in just grabbing whatever information you read in the headlines, and it takes away kind of that benefit of the systematic approach. So I really think that there's no replacement for that.
Absolutely. I mean, with Twitter, the funny thing about Twitter is whatever you want to find, you'll find.
That's right.
If you're bullish, you'll find somebody else that's bullish. Yeah, and more. That goes without saying, Katie. Getting back to let's play a little. I don't want to say a game, but let's just look at you and your process in analyzing the S&P. I don't want to go back to what you've analyzed in the past. Let's start off with where we are right now. You and I are recording the last day of November. A lot could change between now and the close today, so we'll keep it a little bit more of a longer term process for your analyzing. And when you look at if you were to sit down today and analyze the chart of the S&P, what would your approach be?
Right. I think you have to have multiple time frames on your radar. So my approach is to first consult the monthly bar chart, looking back decades. And on that chart, very, very simply, you see an uptrend. I don't think anybody could argue against that. So long-term uptrend, new all-time highs. And that's our framework. I think right there we have our bullish framework within which we want to look at the intermediate term and the short-term gauges. Long-term momentum is positive by our measures. Overbought conditions are in place, but they haven't given way to any downturns, and that's when we tend to pay attention to those. So that's what we have going on the monthly chart. On the weekly chart, there was a bit of a whipsaw in momentum that everybody felt between around late October. And that whipsaw has given way to now a breakout. So a breakout is something that we give a lot of weight to. The breakout above the September high for the S&P 500 has no implications for the short term, but it does have a bullish intermediate term takeaway. And our intermediate term is anywhere from about 2 to 4 months. So that puts us out into Q1 of 2021 as having a bullish bias from the fact that previous resistance level where the S&P 500 met sellers has been cleared. And you see a lot of that on the individual stock level as well, especially in the value arena where we've gotten a lot of breakouts for stocks that had been range bound for much longer than the S&P 500, really several months. So those breakouts are promising from an intermediate term perspective. And then short term, we're just watching the momentum gauges, still positive here, and overbought conditions as being so far manageable, not yielding a downturn. And we're just staying the course with all of that in mind. Then the market internals will also, as I mentioned, inform our research as well. And they do happen to be near extremes. And I'd say primarily we're focused on sentiment to that end, where sentiment can be described by a couple of measures as overly bullish or extremely greedy. And it's looked at, as you can imagine, from a contrarian perspective, like the market may have gotten ahead of itself here, about 11%, upside for just the month of November. And yet we still give more weight to the momentum gauges and they still support the uptrend. My thought is that the sentiment gauges, which tend to have a little bit of a lead time when they reach these levels, will see a pullback in the S&P 500 develop in a couple of weeks. And then it becomes a judgment call. How do you want to position with that in mind? And that's really more of a decision that's not technical, but rather to say, okay, do I want to add exposure irrespective of the possibility of a pullback? Do I want to wait for that pullback, knowing that it could perhaps come from higher levels? Is this stock high beta? Is it growth or value? My sense is that perhaps growth will have its turn again here after having seen value outperform for a few solid weeks. The FANG plus M stocks, so Facebook, Apple, Amazon, Netflix, Google, Microsoft, they are all relatively oversold, and they also are proven long-term upside leaders. So if their oversold condition gives way to some buyers or buying interest, then of course that could contribute to a little follow through for the major indices in which they have a pretty big footprint. So that's where I'm thinking for the S&P 500.
Traders, we're going to pause for 30 seconds and we'll be right back. A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Learn more at tryttnow.com. RJO is a long-standing brokerage firm with personal broker relationships to help you learn and trade futures. To learn more, please visit rjofutures.com. Okay, so I understand your overall thought process and how that works. And one thing I want to dig a little bit deeper here in a second, but one quick question that I have for you is, what defines overbought or oversold for you?
It is measurable. There's a lot of indicators that we have at our disposal to gauge it. I think it's a highly overused set of terms because
that's why I asked that
something
question.
Isn't necessarily overbought just because it's gone up strongly. So I tend to use something called the stochastic oscillator. A lot of folks use something called the RSI, and there's other measures out there as well. And it is something that tends to be looking at where price is closing to sort of a specified range over time. And the idea, if it closes progressively higher near the high end of that high-low spread, then we get more and more overbought. And that's how we measure it. It's something that's somewhat common, I would say, among technicians to have one of these tools on your radar. And they can add a lot of value, especially as it pertains to a sell discipline, which I think we all struggle with.
I think most traders are familiar with those two indicators you mentioned, stochastic and RSI, but because you're a CMT, you actually understand how the indicator works. Can you just quickly tell everybody how those indicators work and then help you in your decision to determine that they are overbought or oversold?
Yeah, I mean, they're formulas, and they're not exactly simple formulas. I would say I'm not going to get too deep into the construction of them, but rather to say that the idea is if they keep closing higher and higher, like near the high end of that high-low range over a specified time, and you can change the parameters to whatever suits your process, that's when the market becomes more overbought. It's just when the momentum is affected by that, that's where you really want to pay attention. So it's a matter of combining those measures with other tools to discern whether momentum is strong enough to uphold that overbought condition, which is often the case, by the way. You'll almost never see a security breakout without an overbought condition. So it's a matter of reconciling that overbought reading with momentum gauges, which can be as simple as moving averages, and also whether a stock or security is breaking out or breaking down. Those things all come into play to kind of shape the methodology. It sounds like a lot, but really it's very visual. It's just, as I said, just going back to the same charts and looking at these tools and how they sort of interplay.
I look at it as confirmation. Instead of just taking one indicator's opinion, we'll call it, you build confirmation around it, and it goes back to your repeating process for analyzing, whether it's a stock or the S&P, that if these things are all happening, starting it off with the RSI or the stochastic, then you build in confirmations and you say, look, we've seen this before.
Right, a higher probability setup. And I think that there's still subjectivity to it, of course, but it's not the indicators that are failing, it's us, right? It's our interpretation of the indicators, which are more important at any given time. And that's the art in technical analysis. It is somewhat subjective, but it also has the value of a more mathematical approach that does make things more, I guess, less gray, right? So more black and white. you can have a buy signal or a sell signal based on some of these tools. And as much as, the inclination sometimes is to stay with a position too long or something like that. Well, if you have a sell signal, you have a sell signal, and then it becomes your own. It's on you to decide whether to do something about that.
As someone who primarily focuses on technicals, how much do you pay attention to central banks? Specifically when we're talking about like the S&P. I mean, this is what brought me more into the macro side of things, is that I just, as a technical person and trader for many years, I just couldn't look away from it. In a sense, I had to start acknowledging how much of an impact it's having. Yeah,
there's no doubt about it. It's certainly a major influence. It's not really my job as a technical analyst to understand that. It's something that I leave to the macro folks out there who are so much deeper into that analysis and deeper into that network. So they'll have a much better understanding than I will of it. But totally acknowledge that as a market influence. Now, we care as much about the prevailing trend as when it's going to end. And so if they have any insight as to when it may end, I'd love to know that as well. But there's so many varying opinions, of course, on that front. So instead, what we will do, and we continue to do, is to just focus on the trend following gauges and honor them as a reflection of exactly that, the central bank intervention, and other trends, whether it's ETFs, whether it's Robinhood traders, you name it, it's all reflected in price already. And so that's what we're going to just kind of stick to and measure. But it certainly, it is an influence. It does matter. It would be great to have a good, deep understanding of it, especially if you can have some insight into when it's going to change. I think that would be hugely valuable. And I would say almost the same thing about earnings. Companies' earnings should drive stock prices over the long term. There are, of course, periods during which they won't matter as much. And I would argue that 2020 has been a pretty good example of that, where unfortunately COVID and other influences have created a tape that's very top-down oriented. So really, folks are more attuned to headlines and macro risks and political risks and everything else than they are the company's earnings. And yet here we are with still a bull market. So I think that's the good news.
Yeah, and all of my friends that primarily follow price, and I'm definitely more in, I follow price as well as a trader. And it just really comes down to a lot of what you talked about. If you're repeating this same process that you're doing over and over again, a situation is a situation, right? What you're seeing in front of you, a scenario, a setup, whatever you want to call it, you understand that there's other factors. There's always other factors, like you mentioned, earnings, and obviously I mentioned the Fed and central banks. But for you, it just comes down to, when I see this setup, I've seen this in the past, regardless of if this is happening now, behind the scenes versus then. At the end of the day, this setup gives me the opportunity to manage my risk because I know where I'm right, I know where I'm wrong. We have an idea of what could happen next here, and that's just how we approach it. You can't be worried about everything. You just have to be focused on what it is that you see and your specific setup.
That's right. There's always a lot to worry about, quite frankly. And so, at the same time, the market can be forging higher irrespective of that. So I think, like you said, it's very important to kind of be mindful of how all of this is impacting price and use that as a way to manage risk and discover opportunities. We try in our research not to be overly predictive. There's always a clear directional bias, but rather to say, here's what we're watching. We're almost feeling like we act as reporters in terms of the market and its setup. So here's what we're watching. Here are important levels. Here where risk is heightened. Here's where risk is lower. That type of thing. I think that's, nobody really has that crystal ball, but there's ways to add value by knowing important levels as just one takeaway from the charts that I think is really incredibly valuable. Just even as simple as knowing where the 200-day moving average is, that can add a whole lot of value. And for folks that aren't aware of where these levels are, they're almost at a disadvantage these days.
Oh, I agree with that. You get a lot of traders out there that will say something doesn't work, or why would you even look at the 200-day moving average? It's so basic, or the 50-day moving average, when I know a lot of traders that make a lot of money just trading literally off of just one or two moving averages. And it's because, once again, they have watched the same repetitive pattern over and over again. And to them, the only thing that matters is not necessarily that it's the 200-day moving average or the 50-day moving average. They watch the reactions to it. They know where they're wrong. If it works and the setup is what they anticipated being, from that point on, they just manage the trade. You don't have, the indicator itself, as you and I have said already a few times today, that's not ultimately what matters. It's about what you see at that moment, what you've learned through experience, and it really just comes down to how you execute that setup.
Right, and at something like the 200-day moving average, it is so widely followed, right or wrong. So you'll even see almost a flurry of trading volume around the 200-day at times as people try to, put on trades or take off trades, whatever it may be. So these levels are widely followed, and for that reason alone, they should almost be on folks' radars. I think that I'm not saying that there's a complete self-fulfilling prophecy there, but certainly it's good to be aware of what other folks are watching and anything that could potentially provide support or resistance. As an example, I was looking this morning at a ratio of the Stock 600 index, so Europe's primary stock index, to the S&P 500 index. And that ratio has been downtrending, of course, for a very long time, but recently in November this month has really turned the corner to the upside, and it broke out decisively above its 200-day moving average, that ratio. And I looked back over the past 3 years, and it was something like 6 or 7 times that it had tested that 200-day moving average unsuccessfully, meaning the ratio had come right up into it and failed numerous times. So I'm not saying a ton of people are watching the ratio and that 200-day moving average, but there certainly is some value to it from a trend following perspective as a guideline.
I agree. And I look at it this way, is if there's anything that I know a lot of traders are looking at, why would I put a blind eye to it? At least watch how it reacts there. At the end of the day, it's information that other people have and can see, and if it reacts a certain way and you have a setup that's confirming it or contradicting it, to me that only helps you as a trader.
Yeah, I would certainly agree with that.
I mentioned that you're so focused in on your process, repeating your process. We got a really good idea of how your process works for developing the idea for that directional bias, as you talked about. What do you use as a tool to help you determine where you would be wrong on, let's just go back to the S&P as we talked about today. Where would you start to say you cannot be holding longs anymore, or something along the lines of, maybe you're not giving that strong of a recommendation, but something along the lines of where what we said to you before, this is now not validated.
And you bring up an important point in that the market will dictate our actions, right? We're here to listen to the market, and if it changes, we're more than happy to change with it. And so with that in mind, we try not to get married to a view if we are wrong or on the wrong side of the market. We won't stay there for very long because the indicators will turn, and we can't really fight against them for too long just because we believe something should be happening. So when we talk about the trend following gauges as pointing higher for the S&P 500, well, certainly if they started pointing lower, we would take issue with that. So there could be a combination of the trend following gauges turning down. There could be breakdowns unfolding from a bottom-up perspective. There could be some significant loss of market breadth or shift in sentiment that could drive it. And that, of course, could be related to some kind of headline. Unfortunately, we have that risk right now. There's major headline risk from numerous kind of lines of thinking here. So I think that there's headline risk, and that, of course, could change things as well. So it's really being somewhat reactive to any significant loss of momentum that would then manifest itself in our indicators. Ideally, we wouldn't have to wait for a breach of support by the S&P 500 or similar to change our bias. We could adhere to something like an overbought, oversold measure, and that would, of course, inform our views as well. So it's really a combination of things, but things that we have been going back to over and over as a way to have that sort of systematic approach. So to understand when risk is heightened, really, it theoretically is as simple as to understand when there's opportunity. It's just, the reverse of those same indicators that we tend to use. So that's what we'll be watching for always. We're always watching for that. Of course, the long-term uptrend that you see on the monthly bar chart suggests that we give more weight to oversold upturns than overbought downturns. So that's something that does kind of trickle down into our research, because the oversold upturns will have a lot more impact in a bull market than overbought downturns, of which there will be a little bit more of those. So we definitely keep that kind of thing in mind.
Yeah, when people talk about trading with the trend, I mean, that's what you're looking at. You do your bigger picture homework. You wait for the opportunities that come back within, we'll call it primary trend, where there hasn't been a ton of damage done on your technical stuff, and then you're seeing those potential setups. We started off today talking a little bit about Bitcoin. We didn't really talk much about it, but I kind of led off the conversation. Before we get into rapid fire today, look, as a CMT, as somebody who does technicals, what are you seeing here in Bitcoin?
Well, Bitcoin is testing final resistance. And I mean, right there today, right now. And resistance is resistance. It's a potential area of selling pressure. Now, it's not a major resistance level because it's not been tested before. So it's not something that's provided resistance repeatedly in the past. It was really only there for a brief period. So it's not a major resistance level, but it is the only gauge of resistance that we have at this moment, unless we're talking about psychological levels, like maybe 20,000. Who would have thought we'd be talking about 20,000 in October, right? But alas, here we are. And so potential resistance in here, overbought conditions, but no major loss of momentum. My sense here, and not to get out of my discipline, out of the technical discipline, is that perhaps it's something that would be best to hold and kind of forget about it, because I think the only guarantee with something like Bitcoin is volatility. And if you're unwilling to live through that, you might just go crazy. So, so I think we can expect continued volatility both to the upside and downside for it. But if you stay the course in terms of long-term momentum, you'll probably be well served there.
I love how true you stay to your technical discipline. It really is so important. I mean, so many traders, especially new traders out there, it's just such an important aspect, I think, of your growth as a trader, is that you continue to do the same things over and over again. You stay within your wheelhouse, and you don't search for different reasons for different markets, different time frames, and you just look for what's happening. You stick to what you do, and so I really appreciate that discipline that you have. So, Katie, we've got rapid fire questions next, if you are ready for those.
Okay, go ahead.
Don't worry, there's no prizes at the end, so everybody's a winner in the rapid fire.
I was hoping there was a prize. Okay, well.
All right, everybody. Our rapid fire segment is sponsored by Trading Technologies. Trade the global markets with TT. They are the world's fastest commercially available futures trading platform. Now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. Learn more at tryttnow.com. Katie, first question for you. What analyst has influenced your career the most, and why?
Oh, that would have to be an early mentor of mine, and Mike Hurley is his name. He's a CMT, a fellow CMT, but also inspired me on the personal front as well. He had a background as a Navy pilot, so he's really incredible. And you find a lot of technicians have an engineering or military background, and there's good reason for that. They tend to think the same way and like the mathematical orientation of the analysis. So definitely Mike Hurley.
What was one of the hardest things for you to overcome in your research?
Oh gosh, I think for me it was really isolating it in a deliverable format. Everybody struggles with taking sort of prose and turning it into bullets. Well, that's pretty much what we do for a living. So over the years, I've learned that my trader audience sometimes has a very short attention span. So to make sure I'm always clear and concise in my research.
Yeah, we really do have short attention spans. It's something. I've been working on this for a long time, getting that attention span longer. How has your methodology evolved over the years?
I think it's just having mentors over time and having the CMT program to lean on. And with all of that, just the exposure to so many tools out there, I think my methodology didn't really form until probably the last, I'd say 5 or 10 years, to the point where I feel like it's in a very good place. It's just picking things up along the way from the various mentors that I've had.
What is one attribute that you believe every trader should have?
We've certainly touched on it in this conversation, is to be systematic in your approach, to have discipline and to have a methodology.
Favorite book about technical analysis?
Gosh, there are so many. Technical analysis of the futures markets is certainly one that's applicable to your audience. But I like to recommend folks check out the CMT curriculum, because they have aggregated a lot of these sort of chapters and segments from other great books to give you a complete picture of the discipline. So I like that.
Honestly, it's my number one recommendation to new traders. I have not taken the course, but I know a lot of people that have, and everyone that I have spoken to about that course, just from me hearing their feedback, tells me that if you're a newer trader and you want to learn about, I know it doesn't teach you trading, but in a lot of ways, it teaches you the skills to get you on the path of becoming a trader. And I don't know any other course out there that I have heard from other people that does that.
Yeah, so that's nice of you to say. And I think that it's also something that has value both professionally and personally. So.
Absolutely. If you had to pick a profession other than being a technical analyst, what would it be?
Well, for a long time, I wanted to be a spy, and that didn't work out. so another thing that I often thought I would pursue is being an artist. I really loved art growing up, and now I've just decided that building these charts and drawing all over them is my new form of art.
Oh, definitely. No doubt charting is, I think, and trading. And there's definitely, you need that artistic part of your mind. What is the best piece of advice that you received about trading?
Well, I think the indicators are here to keep us honest. So not to hold a position past its point of our performance. And the tools that we have can help us sort of facilitate that self-discipline. So don't get married to your positions.
If you could give a piece of advice to the younger you about investing, what would it be?
I'd say respect the trend. And that's, at the end of the day, what technicians are trying to do, really, to understand the prevailing trend and understanding when an inflection point might be near. So to respect the trend. And, it follows on with not getting married to a position. I know a lot of folks that are new to the markets have ridden the market off of that March low, and they're staying with it, which is great. But when it changes, they need to learn to change with it.
If you had an elevator pitch me the edge in using your service, what would you say?
I think it does facilitate that systematic approach to technical analysis. It takes it off your shoulders to some degree and gives you a full, really, picture of the U.S. equity market, starting with the major indices, drilling it into the technical themes and sectors and long-short ideas, while also with an eye towards those market internal measures and macro technicals, things like crude oil prices, gold, treasury yields, the dollar. All of that informs folks and helps them understand where there are opportunities, how to manage risk, and to just stay on the right side of the market and avoid those major downdrafts that we're all trying to avoid, 2008, 2000.
Last question for today, Katie. Favorite thing to do when you're not studying markets?
Oh, that would definitely be spending time with my kids. I have 3 great kids, and they've been home a lot more in this environment, and I've been trying to value that in light of everything.
Well, Katie, I'm a fan of yours. I know several other traders that I've spoken with are fans of yours and your analysis. We talked a little bit about it today. Where can people go to learn more about you and the service you provide for traders?
Well, thanks for saying that, and thanks for asking. I do have a website. It's fairleadstrategies.com. And I do also have what I would call a not great presence on social media, but you can find me on Twitter and also on LinkedIn. So please reach out if you want to educate yourself on our service or technical analysis in general.
You're speaking to somebody who's really, I just love Twitter. I'm on Twitter all the time. Not as much, actually, a little bit lately, just when everything started coming up with the holidays. I've been taking a little time off, but for the most part, I'm pretty much on there all the time. And I could tell you this, we definitely would welcome more posts from you, Katie. So everybody go and check out Katie on Twitter. Katie, it was such a pleasure to speak with you today. Thank you so much for your time coming on Futures Radio Show.
Thank you, Anthony. Take care. Good luck with your trading.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.